Hello and welcome to our next video lecture on Chapter 3, Accrual Accounting and Income. We are going to discuss our first learning objective, which is how to explain accrual accounting and how it differs from cash-based accounting. So first of all, accrual accounting, the key fact here is that it is GAAP, Generally Accepted Accounting Principles. So this is the only requirement. We can use this for GAAP. Cash basis is not GAAP. It is not allowed. And basically, when we use cash basis, it's usually for taxes. So, accrual accounting, you do things when they are incurred, regardless of when you receive any information or any money. This is the key here. Revenues are recorded when they are earned, and expenses are recorded when they are incurred. Whereas in cash accounting, it's basically when you receive the money is when the expenses are recorded. Accrual accounting gives you a better picture of what's happening in the organization, of the financial stability of the organization, right? Because it shows the stream of revenues that you receive, and it also shows the stream of expenses. So accrual accounting and cash accounting, you basically have to record any money. So the key to note to all of this is any dollar amount has to be recorded. So if you're borrowing money, if you're issuing stock, so any money coming in or out is recorded. In accrual accounting, again, remember, it is recorded when revenues are earned and expenses are incurred. Now, you also have to record any non-cash transactions. Just because you do not receive cash doesn't mean you didn't earn it or doesn't mean you didn't spend it. So sales on account, accounts receivable, you record that, right? The goods are sold to your customer, so you're going to debit accounts receivable and you're going to credit sales revenue in this instance. When you purchase inventory, if it is on account, you get 30, remember 210 net 30, 2% discount if you pay within 10 days, otherwise the net is due in 30 days. Well, if you purchase that and you haven't paid it yet, you still have to record that purchase. And we're going to talk more about accruals of expenses. You actually have incurred the expense, that's the key, but you haven't paid it. Depreciation is a non-cash expense. As you will learn, we do debit depreciation expense, and we credit accumulated depreciation. And accumulated depreciation is a contra asset account. And you see there's no cash involved in here, but we still have to record the expense, which is the usage of the asset. And then you also have to record the usage of any type of prepaid rent, insurance, and supplies. So the time period concept basically is that accounting information is given at regular intervals, normally monthly. You see that financial information can also be presented quarterly or annually. You have a 10Q, which is the quarterly report produced from companies that are publicly owned, and then you have a 10K, which is the annual report. Most companies use a calendar year, meaning it starts in January and it ends in December. A fiscal year is any other date and time. Some non-for-profits, like schools and higher educations, they may have a 6/30 ending date. Same thing, you might have a 4/30 ending date for certain insurance companies. So now let's move on to learning objective 2, where we're going to apply the revenue and expense recognition rules. So 2 items have to exist in order for the company to record revenue. So basically, when to record the revenue and how much to record the revenue. So basically, revenue is recognized when the business has to transfer the goods or services to the customer and in the amount that reflects the cash or the fair market value or any other type of consideration that the company expects to receive in exchange for the goods and services. So basically, the amount is usually the amount of money, and when you record it is when the exchange has taken place. So now we talked earlier about FASB and the IASB, the Financial Accounting Standards Board and the International Accounting Standards Board. So they have worked in what's called a global convergence, and they wanted to produce standards that are consistent. And they did. And then we have these 5 rules of revenue recognition. It's called auditing standards update, and it was done in September of 2015. So this is hot off the presses. And basically now you have to identify the customer, identify performance obligations. You still have to determine the price, but you have to allocate that price to the particular performance obligations of the contract. And then when it is satisfied, that's when you do your performance obligation. So basically now we're looking at revenue recognition in terms of a customer contract. And this just happened, as I mentioned, in September of 2015. So basically here we're looking at some information for guidance on revenue recognition. In this case, we're talking about Starbucks. And so here, this individual wants to start drinking Starbucks. Well, great, come to our store, try this sample. Nothing happens here. No transaction has to take place, right? We don't have any money that has been exchanged, and we don't have any deliverance of any goods or services. But now, if you actually buy that latte, here's where we start recording the sale of the cup of coffee. And here we would debit cash, assuming that this customer paid cash for her cup of coffee, and Starbucks would credit sales revenue. And let's assume we paid $5 for that latte. This would be your transaction to record the revenue that should be recognized at the time of sale. Now, for the expense, we have to identify expenses same way incurred, and we measure those expenses in the same period in which the related revenue was generated. So we have here known a matching principle. Basically, we match revenues with expenses. And recall, revenues minus expenses equals your net income. And remember, that is on your income statement. So we record the expense when it's incurred, and we try to do that in the same period in which the revenue was recognized. So now what we're having is we have revenues and expenses, and so we have our net income, right? Revenues minus expenses equal net income. This is on our income statement. And in this, so we recognize the expense of a period against the revenue in which it earned. And then you have here $700 revenue with the $800 expense. See, this is what's causing us to be swayed, right? Now we can go from a $200 net income to a loss of $100. So at this point, pause the video and go through this activity. And so right now we have that a customer pays Starbucks $250 on March 15th for the coffee to be served at a party in April. So has Starbucks earned any revenue? And when will Starbucks earn their revenue? Well, Starbucks hasn't earned any revenue at this point in time, right, which is March 15th, because there's been no cash and no delivery of the coffee. So Starbucks earns its revenue in April when they will actually have the party and deliver those goods. Now, Starbucks pays $6,000 on July 1st for the store rent for the next 3 months. Has Starbucks incurred an expense? Not at this point because it is July 1st. So this entry would be recorded as a debit to prepaid expense. And we're going to go through these, but the more I tell you, hopefully the more you will learn it. And then we're going to credit cash, right? So this is going to be $6,000 and then $6,000 of cash. So at July 31st, that's the first instance of an expense that we're going to incur. So at the end of the month, we would actually have to debit rent expense for $2,000 because that's 1/3 of the rent, and then we're going to credit prepaid expense at this point because we don't pay it again. We actually just reduce our asset of prepaid expense to show the usage of 1 month's rent. So our prepaid expense account will have $4,000 and our rent expense account will have $2,000. And that's where we'll stop this video.